In today's video, I'm going to share 3 stocks that I think have high growth potential, but they are some of the more risky opportunities out there. As always, this is not financial advice, and please do your own research before adding any stock to your portfolio. Now, just to be fully transparent, I have one of these 3 stocks in my portfolio. Currently, it's not a very big position, but I do plan to add to it over time, and I will make that very clear as we go through this video. Do let me know if you currently own any of these or if you plan to in the future. These 3 stocks are not really common stocks. They're not Nvidia, Palantir, Tesla, anything like that. But without further ado, let's just jump in and go to stock number 1. The first company is Hims & Hers Health, ticker symbol HIMS. This is a telehealth company. What does this mean? Well, it means someone can get health advice, someone can get prescriptions online without having to actually physically attend a doctor's appointment, a doctor's office. So it's basically the distribution of health services via digital information, basically computers and mobile devices. Hims & Hers Health are kind of changing and paving the way for what a lot of people think future medicine is going to be like. And they actually first started as just Hims, but now they're Hims & Hers. So clearly they are seeing some sort of success and they've decided to expand. But they offer a variety of different things. They offer telehealth consultations, prescription medications, over-the-counter products, mental health services, and they really try to focus on privacy and convenience. And we all know that in this day and age, convenience is a massive thing. No one anymore wants to physically leave their house, that's maybe kind of bad, and go and sit in a doctor's waiting room for 40 minutes, however long it takes, then physically see someone in person, then there's a waiting game afterwards, they have to go and get their prescription. No. People nowadays are all about speed, convenience. And we're seeing a lot of services, a lot of different products and companies actually pop up to deliver convenience to our generation. And this is kind of what Hims & Hers Health are doing as well. They're just doing it in the healthcare sector. And I think as we see the world adapt and change even further moving forward, a service like what Hims & Hers Health are offering are gonna see even more high demand. Now, this doesn't mean that there aren't any risks with this company and investing into a company like this, and we'll get onto that in just a minute. But let's actually take a look at how the stock has been performing. So I'm just looking at Hims & Hers Health stock compared to the S&P 500, of course, a very well-known index tracking the 500 or so largest US companies. And I'm looking at this on a platform called Seeking Alpha. Now I have Seeking Alpha Premium. It's where I do a lot of my stock-based research. If you want to try that out for 7 days, free trial, and you want money off if you do decide to commit, I'll leave a link for you in the description below. But anyway, what can we see here? Well, we can see that over the last 1 month period, Hims has outperformed the S&P 500, returning investors just over 16%. Now, this is where things get a little bit crazy. If I expand to a year-to-date view, we can see that they have had an absolutely fantastic year so far. Over 73%, basically 74%, which is, incredible. Way outperforming the S&P 500. And, if we did this video a few days ago, maybe a week ago, we would have seen an even bigger difference. However, what we can also see is that a company like this, in its early stages, in its growth stage, just the company it is very volatile. Look, a massive jump, and it's fallen. And if you just compare it to quite a stable ETF that is tracking the S&P 500, it will look vastly different. But there's no doubt that it is one of the best performing growth stocks across the last month or so as well. It's been doing very well. Now, if we expand out to a 5-year period, what you can see is that actually they only had their IPO very recently, meaning they only went public back in 2020. You can see that here. And as we typically see when a company does do an IPO, they did experience quite a quick peak that you can see here, and then quite a sharp decline as well. And this was alongside the 2021 bubble that we all probably experienced. So just having a look on the growth section on Seeking Alpha, we can see that Hims growth grade is coming out as an A, their revenue growth year over year an A, which is really fantastic. And their revenue growth forward looking is coming out as an A-, again, very good. So the Seeking Alpha analysts and the Wall Street analysts are actually suggesting that investors buy this stock right now. That doesn't mean that you should absolutely just go and buy this on this basis, but I'm just showing you some of the other features that Seeking Alpha has. So how do their financials look? Clearly, when you're deciding what stocks to add to your portfolio, one of the big things that you need to look at and really understand and investigate is a company's financials. Now, if you have no idea how to do that, don't worry, I've got you covered. I've made an entire workshop that people are really, really enjoying. It's really comprehensive. It will take you from step 1 all the way to adding a stock to your portfolio in terms of research. Again, I will leave a link in the description for that. But Hims & Hers Health have had consistent revenue growth, which is a really, really good sign. And recently they've switched to profitability. They recently reported their first ever positive net income quarter during the fourth quarter of 2023. But of course, this isn't vast amounts of data, so we're going to have to keep our eye on it and see what happens next. Now, their cash to debt ratio is looking pretty good, and their subscriptions are increasing well and increasing regularly. So, with all that said, everything that we've just discussed, why might this actually be a risky investment? Why has this company made it into this video? Well, to be honest, I don't really think that it's one of the riskiest out there, in my opinion. It looks pretty good, and I'll personally be doing my own further research on this. But what I would say, some things definitely to be aware of and take into account is that, like I said, they are a very newly publicly traded company. And that means that we don't have vast amounts of data to actually analyze. And not many other companies have really come before them to scope out the landscape. However, they're doing things a little bit different. And, hats off to them. Any company that comes along and changes an industry has a really, really strong chance of becoming a massive thing in the future. But without having the landscape already scoped out, it can be quite difficult to pave the way. And with that said, it is becoming a very highly competitive market. And a lot of analysts are actually kind of concerned that it would be super easy for some of the really big players, like an Amazon, to come into the space and actually steal market share quite easily. Let me know what you think about that in the comments below. What else do I quickly want to tell you about this company? Well, it is a founder-led company, and personally, I do prefer a founder-led company. I think that it says a lot about who is running the company and how in-depth they understand the company and the land and the sector landscape that they're in. But to me, it's not a be-all and end-all. It's more just a nice to have. Okay, with that said, let's move on to stock number 2. Now, this stock is the one that I do have in my own portfolio. Like I said, it's not a massive position, but I just wanted to be really transparent there. And that stock is Intellia. Ticker symbol NTLA. So why do I have a small position in Intellia Therapeutics? Well, it's because, like I kind of see with robotics, AI, blockchain technology, autonomous driving, etc., all these big up and coming technologies, there is a big revolution happening. And that is now happening in the gene editing and genomics space, which you can really see if you start looking at the declining costs and actually analyze Wright and Moore's law. But I won't get into all of that in too much detail in this video. I will link you actually to one of my videos on my main channel where I spoke about this in more detail somewhere on the screen now if you are interested. But I just basically see this big change coming in gene editing and genomics, sequencing, all of this stuff, and Intellia are one of the companies that are actually making movements within that industry. So Intellia are a company leveraging gene editing technology to develop therapies for curing genetic diseases. I won't get too heavy into the science behind all this, but they focus on both in vivo, meaning inside the body, and ex vivo, meaning outside the body, therapies using CRISPR. CRISPR, put simply, is a technology that allows precise gene editing. And this, of course, means that you can then cure genetic diseases. Diseases that are caused by errors in the genetic code, if you can edit those errors out, you can cure the disease. That is obviously a massive oversimplification, but just to give you an idea in case you've never heard about this before. Right now, there are actually many companies operating in this space, and many of them are looking pretty decent, Intellia being one of the options. Because it's such early days, it's really challenging, and I don't really think anyone can actually do it right now, to pinpoint, to select which one of those companies is going to be the leader and is going to move the fastest and have the biggest profitability and, give the most back to investors. It's just too difficult at this stage. So for some people, it might be better just to opt for an ETF or something like that, rather than trying to pick an individual company. But for me, what I wanted to do is just kind of get my money into a position that has exposure to this over time. And if things change, I can move my money around to adapt as necessary. Intellia right now have a number of programs in their pipeline with their therapy for ATTR in the late stage clinical trial phase. So there clearly is potential for a company like Intellia Therapeutics, but why have they made it on to this list today? Why are they perhaps a more riskier investment than something else? Well, one reason is because regulations within this industry are incredibly tough and incredibly strict. The FDA in the US or the EMA in the EU are responsible for approving any new drug. And even if a drug passes all of its clinical trials, there is absolutely no guarantee that it will be approved by the FDA or the EMA. They can request more data, they can delay approval, they can even reject applications. So if this were to happen with one of Intellia's therapies or one of their drugs, this of course could then cause a massive drop in the stock's value. However, this also works on the flip side. If the FDA approves one of Intellia's drugs, then of course it would be expected that the shares will absolutely rally. I do also want to point out that the financials are not fantastic for this company. There does look to be some slight financial issues currently. For example, they've got some really promising programs, but they don't really generate that much revenue right now, and they are consistently unprofitable as it currently stands. But still, any meaningful progress from its leading candidates, from its leading therapies that they are now looking into, could send the stock price absolutely soaring, especially as they edge closer to any approvals. So I think what we've got to say about this one is there is massive market potential. However, lots of time and patience is needed to be an investor into a position like this. Okay, so year to date compared to the S&P 500, NTLA Intellia Therapeutics has underperformed the index, and it has been quite rocky, quite volatile. If we expand out to a 1 year, we can see that again, they have underperformed the index quite significantly, minus 24% pretty much, and they had a massive decline happening here. And if we expand out to a 10-year period, because they only went public not that long ago, so we don't have vast amounts of stock price data. But you can see that over the lifetime that we have got data for, they had a massive surge and then a really sudden fall. It is going to be risky, it is going to be volatile, it is going to be quite choppy compared to something more steady, but that's kind of what we expect with a company like this. The last stock on our list today is a company that has done really crazy things this year so far in terms of stock price. Now, you might be thinking, well, it must be Nvidia. No, it's not Nvidia. However, their stock price increase has kind of been due to Nvidia in many ways. If you haven't already guessed it, it's SoundHound AI, which is kind of hard to say, SoundHound AI, but they are a generative AI voice company. Their products can understand human speech, process requests through large language models, LLMs, and respond with computer-generated voices. Great. So what is the real-world use of that? Well, actually, there are many different industries, many sectors out there that could benefit from a company like SoundHound, many real-world applications. So let me just share with you a few. The first one is within the hospitality industry, restaurants in particular. SoundHound can be used to take orders and reservations over the phone, and this means that you can basically have way more capacity. So if you've got a dinner time rush or, something's really busy at a particular time within a restaurant, you don't need to then get 10 times more staff in. No, this will replace staff in that sense and free up staff to do other things. And with the use of AI as well, what you can basically do is sort of predict and see different restaurants where there is going to be availability. So, if someone is trying to book at a certain branch and there's no seats, the SoundHound products can see to that request and then suggest a different chain, a different restaurant within their chain that they can go to instead, where a table is going to be available at the time that they want it at, if that makes sense. SoundHound also recently acquired a company called SYNQ3. I don't know if that's how you actually say it, but they are basically a leading provider of voice AI and other technological solutions that are specific for the restaurant industry. And at the time of acquisition, they had over 100,000 restaurants in their pipeline and 10,000 partnerships. So there is a lot of possible expansion within the restaurant industry that SoundHound can now really capitalize on. The second use is within cars, where SoundHound can deliver ChatGPT and other chatbot services without a network connection. And actually, one of SoundHound's technologies are already being utilized within the automotive industry. So they have a sophisticated voice AI technology called Iris, and along with NVIDIA Drive, this is being utilized within Stellantis cars in Japan. And this means that those cars will be able to answer questions in 17 languages about the car and the world around it. And you know, there are many more industries outside of just these two that SoundHound could really make a mark in. Retail, hospitals, the list kind of goes on here. So I mentioned that NVIDIA had something to do with why SoundHound stock has been going so crazy recently. And this is because NVIDIA disclosed in a recent SEC filing that they actually had a stake in this company. And of course, with all the interest in NVIDIA lately, this just caused SoundHound stock to go absolutely crazy, which we'll take a look at now. So here we are, and you can see that currently one share of this company with this stock will cost you $5.89, and the ticker symbol is SOUN, SoundHound AI. So let's just take a look at how this company has been performing. Well, over the last 1 year, incredible, absolutely incredible. Way outperforming the index, returning investors over 194%. If we just take a look year to date, again, absolutely fantastic performance. Now let's just go to a 1 month period. Again, doing quite well during different periods, but overall not outperforming the index and has been a little bit more volatile, as we've seen with all of the stocks today. And I believe it was around this time that we saw this massive increase happen that was caused by that NVIDIA SEC filings. Okay, so why could this be potentially a more risky investment? Well, it's because there has already been massive stock price increase. Could this continue? Can the momentum carry on going forward? Or actually, is this now becoming an overvalued stock? Let me know what you think about that in the comments below. Of course, with any risk and reward, you do have to balance it up and think about your own situation, your own risk capacity, your own risk tolerance. So for some people, these won't be that risky. For others, they will be, you'll never invest into these sort of companies. It's got to be dependent on your situation. Also, like we spoke about with Hims & Hers Health, there is the potential that big mega cap established companies like Microsoft, like Google, could compete easily with the technology that SoundHound have. And if we think about Tesla in particular, they could really easily compete within the automotive industry. And there has been quite a substantial recent downgrade in terms of a price target from $5.80 per share to $4.90 per share. And the reasons for this downgrade were given as a murky operating model, a business that's in its infancy, decelerating growth, insufficient capital spending, potential customer losses, and potential competition for big tech. So those are some things that you want to consider when researching this company. As always, I invite you to leave any thoughts that you have on anything discussed in this video in the comments below. But until next time, keep analyzing, keep investing, and don't forget to hit that subscribe button.